Ready to go. All right. Well, welcome everyone. We're excited for you to jump on here we're going to probably take about half an hour of your time this afternoon. We've invited Steve Beachy, who is a local CPA. CPA stands for Certified Public Accountant. And he is located in Lidditz here in Pennsylvania. And we've asked Steve just to come in and share some ideas. Steve has a lot of amazing background in this topic, and he could go on for hours, he said, but we said perhaps we'll keep it to 30 minutes. We do want you to have the freedom to ask questions. So if you have something as pops up, the questions we want to be more a generalized question, not a personal question. We can take those at another time if you would like, please, but this is just more a general question if you have that. Steve will be happy to help you with that. So Steve, you had a list that we gave you, but I'm sure you've got lots more that you could chat about. So welcome. Thank you for taking your time from a busy schedule.
Glad to be here.
And we appreciate what you've got to give us. So I'm going to step aside so you can just watch Steve and not me.
And Wendy will jump in if something I say doesn't make sense or is too technical or anything like that. So one of the first things that we wanted to talk about was what's different for 2021 than for 2020. And there's really not a lot of changes. They've been trying to pass a lot of legislation. And if you watch the news, you know there's been a lot of logjam in Congress and nobody agreeing on anything. So there hasn't been a lot of legislative changes to the 2021 tax year. One or two small changes. In 2020, the first $10,200 of unemployment benefits that people received were exempted from tax. That was not duplicated in 2021. So people may get a little bit of a surprise if they got benefits that spilled over into 2021, that they won't have that exemption. And from what I'm hearing, there's very little likelihood of that being replicated in 2021. One of the other changes that was a 2020 change only that may apply to some people in the audience is if you are part of the health care exchange and you receive a subsidy, you will have the potential to have a repayment of what they call the advanced premium tax credit. What they did in 2020 was they eliminated the repayment. So somebody may have owed a few $1,000s back because of that, and all of a sudden didn't owe that back. That is not something that they made effective beyond the end of 2020. So again, it's something as I'm working with clients, it's something that we have to be aware of, managing their income and trying to make sure we stay under a certain threshold to not trigger, because that repayment can go from a few hundred to thousands of dollars, and that cliff can be quite severe. One very minor change, and we'll talk a little bit about itemizing versus not itemizing, but for the non-itemizers, Congress gave a $300 front of your tax return deduction for 2020 for charitable contributions. Doesn't make a big difference, but every little bit helps. After they did that, all the married couples said, well, wait a minute, the single people get 300. There's two of us. Why do we only get 300? So they changed it for 2021. So it goes from 300 for a single to 600 for a married filing joint return. Again, that doesn't matter if you gave 600 or 6,000, you get 600. Now, if you only gave 200, you only get 200. Of course, it's not an automatic deduction, but whatever you gave, you get to deduct on the front of the tax return up to that 600 for married, 300 for single. And one thing that I think is highly unlikely, but if you have family, you can make sure that they know about this. IRS was sending out at the middle of each month from July through December, they sent out payments for advanced child tax credits. And that's going to be a royal nightmare for us as tax preparers to deal with. But what they're doing now is sending out letters that tell the taxpayer how much they received and how many dependent children it was based on. Because this is going to get really dicey when we start getting into split custody where they alternate years and things like that. It's going to be fun. But one of the things that I've seen already that I wasn't anticipating is IRS is sending out 2 letters, one to the husband, one to the wife. Normally, when IRS sends a notice, they send the exact same notice to both spouses, and they are identical by design because they're just notifying each party in case one isn't getting the knowledge from the other person, that type of thing. They're notifying each party. But if they send a notice saying that you owe $1,000 and they send your spouse a notice saying you owe $1,000, you don't owe $2,000. It's just one notice duplicated. These letters for the advanced child tax credit payments are individual. So if somebody received $1,000 in advance payments for their child, one spouse is going to get a letter that says $500 and the other spouse is going to get a letter that says $500. So that is going to be critical that the tax preparer gets both of those letters and not just one, because both have to be factored in. IRS has already said if we get a return that the information reported on the return doesn't match what our records show, it will delay the processing and delay the refund. So something to keep in mind. So that's about it for changes from the 2020 tax filing. A topic that is evidently near and dear to Wendy's heart is how long do I have to keep things? How long do I have to keep my records when it comes to my tax documents? I have a fairly standard answer, and I like it. It's forever, but I understand not everybody's like me. So what I would say is at a minimum, keep 3 years of tax documents. And when I say tax documents, I don't just mean the tax return. I mean all of the source documents that were a part of that return. And I would recommend when you keep your tax returns, you keep those tax documents all in one spot. The 3 years is the absolute minimum. If you have the space, I would recommend 7 as a best practice. However, there are some situations where you need to keep documents longer than that. Mostly surrounding property, but there can be some other areas too. So for example, if you buy a property in 1995 and you haven't sold that property yet, whether it's a rental or anything else, having that cost basis is critical to knowing what your gain is going to be. So any property that you've purchased and not sold yet. Another place that you can run into issues is what's called a like-kind exchange. So if you had a rental property and bought that in 95, but in 2002, you did a like-kind exchange and went to another rental property. In that case, if you get rid of that 2002 tax return without having the proper documentation pulled out of it, it can lead to problems, again, determining cost basis when you go to sell that property. So, if we're just talking the run-of-the-mill tax return with, interest, dividends, W-2s, retirement income, that type of thing, 3 years, maybe 7 if you can find the space for it. But if you've got activity like property purchases, property sales, things like that, you want to be looking at those a little bit harder and keeping those documents longer. When you get into the investing world, a lot of the current investment activity is captured and cost basis is captured. But if you've got stock that you've held for long periods of time that the investment advisor doesn't have cost basis for, getting back to that cost basis again is going to be much harder the further away you get from that. So it's something to look at and say, okay, do we have the cost basis? Do we know what it is? You know, if it's investments that you've received either by gift or by inheritance, those have different rules for how that cost basis comes to you. So those are all special areas where there's some special attention to be paid to that.
The only thing, we have some individuals who have like a small business venture. Does the business side of this change this, Steve, that you have to keep it longer?
Yes, especially if there's payroll in that entity.
Okay.
Payroll records, really, you need to keep all payroll records until an employee is terminated and then a period of time after that. So that's definitely
Okay.
when you get into more of the nitty gritty, like, you know, bank statements and things like that, you can have a shorter retention period, because those are things that if IRS wanted to come in and ask questions, it could always be acquired from the bank itself.
Okay. And then one other question as it relates to that, do they need to keep it physically or can it be a virtual copy of the document?
Personally, I have all my tax returns from the time I started filing back in the mid to late 80s, but they're all digitized. I have them all scanned and saved and archived in my on my hard drive. So yeah, it doesn't have to be physical. And that's where I kind of default to the mindset of I keep everything, because hard drive space is cheap. When it's physical documents, it definitely becomes more cumbersome. So, you know, we talked about if IRS comes knocking. So one of the questions that comes up from time to time is, what is the likelihood that IRS is going to come knocking? And the reality is it's pretty low. I don't like to live in that mentality, because doing it right is doing it right, regardless of whether or not you're going to get caught by not doing it right. But it is a relatively low likelihood that IRS will come and do what we would consider a full-blown audit. They may send notices out asking questions. Usually what I see a lot of is matching notices, where IRS got reported some kind of information and it didn't appear on the tax return. And a lot of times it's just an oversight by the taxpayer. They forgot they had that. It was something kind of off the wall and unusual, and it never made it to the preparer. But sometimes it's very legit. I mean, I helped someone with a notice. They forgot a $35,000 W-2. They just forgot about it, and IRS noticed. So that notice basically comes to the taxpayer, and they bring it to the tax preparer. And as a preparer, I look at that and say, okay, this is correct, or yes, this was missed, but this is another factor to it. And so, yes, you owe IRS money, but it's not the number they're saying. None of that is an audit. These are all just matching notices, looking at discrepancies between what's been reported to the IRS by third parties and what's been reported by the actual taxpayer. So I don't even know the statistics, but it's fractions of percentages of the likelihood of having an audit. Where you would see the potential for that is when you have outliers to the statistical data. So IRS will look at certain things like charitable contributions or mortgage interest. And if what you've reported on your tax return based on your adjusted gross income grouping is substantially different from what the norm is, that could prompt a question. So for example, if you have adjusted gross income of $100,000, but you've reported charitable contributions of $50,000, that may prompt a letter. And they may just ask for more supporting documentation and clarification on what makes up that charitable contribution number. And there's a number of reasonable answers as to why that could happen. I mean, maybe there was a significant source of non-taxable income from an inheritance that created the cash flow ability to make that kind of a contribution, but it didn't affect the adjusted gross income. There could be a potential error that caused that. A QCD that was misreported, so there was no taxable income, but a deduction was taken for a charitable contribution that shouldn't have been. A QCD is a qualified charitable distribution from a retirement account. And it's a very powerful tool, but there's certain steps that need to be taken to report everything properly. And so if not, again, you can have some errors that occur, and IRS is prone to question that type of thing. I've been preparing taxes for over 25 years, and I have only ever seen what I would consider one full-blown audit in that time period. And it was of an individual, but again, he had a number of business ventures, I think that brought him into the range that IRS wanted to even take a look at. So IRS audits aren't anything to be afraid of, because at the end of the day, if everything's been done properly, there's nothing to fear.
Clarify some things. Sometimes individuals will come up with maybe a 1099 DIV or something after they've filed.
Mhm.
Or in some cases, maybe they forgot, oh, that's right, I did a Roth conversion, or I just forgot this amount. Is everything need to be amended, or would you say, no, if it's $100, don't bother? Is that everything amend, or if it's an amount less than, don't bother?
So yeah, there's definitely thresholds to that. And the other place that we see it is just with corrected 1099 divs and that type of thing, where they send it out 2 months after you got your original form, and all of a sudden numbers are a little bit different. Ultimately, it's the taxpayer's choice. My recommendation is typically, let's look at the numbers and see what the tax change would be. And so it's not unusual that I get that call, and we do that analysis. Say, okay, your tax would increase by $82. I would not file an amended return for $82. It's just not worth the additional cost of having to prepare it. And what I typically do in that scenario is say, write a note on it with the amount of the tax that that I'm telling you may see. And if you get a notice from the IRS, by all means, show it to me. But if it's for $82 due, then just pay it because it was right. Because typically IRS isn't going to assess any interest or penalty on a balance of that nature. So, and I would also say the odds are you're not even going to get a notice. But if you do, just pay it. I do remember in one CPE session, continuing education, IRS sends out, I think, around 5 million of those matching notices saying, this is what we got, this is what you said, here's the difference. That 5 million is only about 20% of the actual matching issues. So they're only sending it on the ones that rise to a level to make it worthwhile for them to send. So one of the other topics that Wendy had asked me to talk about a little bit is paying quarterly estimates or not paying quarterly estimates. And my suggestion is wherever possible, avoid paying quarterly estimates and use withholding as a tool. And here's why. We talk about quarterly estimates, which is a horrible description of it because they're not quarterly. They're 4 times a year, but they're not clean calendar quarters. So it gets very confusing for people the first time and the second time that they go through this process, because you have to pay one on April 15th, but then I have to pay one again on June 15th, not July 15th. Then it's based on different time periods. And then I do it again in 3 months, but then I don't do it again for another 4 months in September. So unless you're a very detailed regimented person, it's a challenge. The estimates on time. So at April 15th, June 15th, September 15th, and January 15th, IRS has the potential to assess a penalty because they look at estimates as you should be paying each time a certain amount. So if your tax liability is projected at $10,000, they want 4 payments of $2,500 each. If one of those is late, they want to assess a penalty. If you forget the first one and pay $5,000 on the second one and then pay the last two $2,500 a piece, they're going to assess a penalty. Whereas if you can structure your withholding to have $10,000 paid in, even if that's on an IRA distribution that you take on December 30th of that year, that $10,000 comes in through withholding. IRS doesn't look at timing. They take the approach of withholding is withholding and timing is not an issue. So even though if you paid your $5,000 with one of your payments being late and then the other 2 were on time, versus they didn't get $10,000 until December 30th, they look at that as being fine, even though you kept more of the money longer. So withholding is a great tool and a very, very powerful option. Sometimes it's just not feasible to have withholding done, depending on the income sources and that type of thing. So if not, then paying with quarterly estimates is an option. If possible, I would recommend that you don't use vouchers and you do it electronically through the federal and state electronic payment system. It's something you can actually schedule ahead of time, and that's something I personally do when I file my tax return and I'm doing my estimates for the upcoming year. I schedule my estimates in April for the rest of the year. So all I have to do is make sure there's money in my bank account and everything's taken care of. It's a lot easier than having to remember to cut those checks. If you do prefer to cut a check and mail it, a couple of things I would highly recommend. A, include your Social Security number on the memo of the check, as well as the tax year and the quarter that you're paying. And while all of that's good, I would also make sure you send it with a voucher. So federal has the 1040 ES vouchers. For Pennsylvania, it's a PA 40 ES. But those vouchers are what tell them how to process that payment, where to apply it. I've had issues with a couple of clients actually where the payments that were made were misapplied. So they've gotten billing notices for 2020 because their last estimate got misapplied to 2021's taxes instead of 2020's taxes. So we filed a return, said we don't owe any money, and now they get notices because they didn't get credit. And again, at the end of the day, the client doesn't owe the money and everything's good from that perspective, but there's a lot more. First of all, there's that initial panic of getting a letter from the government that says you owe taxes. There's that headache. But then just tracking down, providing the documentation and the proof of when the payments were made, where they were applied, and it's just headaches that you don't need if you make sure you do that. So I guess one last piece to that, one thing I would highly recommend avoiding is using a bank's bill pay system, because then there's no way to send that voucher, and you're putting some information into the bank's bill pay system that you may not want, like your social security number, you may not want that recorded in their system. So I would try to either write a personal check or do it through some of the online options, which are very secure.
So Steve, we had a question. Someone got a notice that they owed $15. Now, besides putting your blood pressure to the top, you're saying just write the check and move on. But the other thing is, on that check notice, put the full social security number on the check. What if the check gets lost? Can you just put the last 4 digits if you have the voucher with it?
Yes, the voucher, well, you still have the same risk
You would have
because
the
the
same,
voucher also has your full social on it.
Yeah, okay.
So I believe, and I'm just trying to remember back, I believe federal, they ask for the full social. State asks for the last 4 digits
Okay.
is my recollection. So
Federal
yeah,
full, okay.
Yeah.
Now, if I pay one estimate, do I have to send in the other 3, or can I just do, like, let's say we're wrapping things up for the year. Can I just send in a 4th quarter payment because I didn't do the other 3?
Okay, well, I think that question is actually going the other direction.
Okay,
I read that as, if you pay one estimate at the beginning,
okay,
do you need to send the other 3? And the answer to that is no. So what IRS isn't doing is keeping track of how much you've paid in, and is it, they're not tracking it from that perspective. They don't know what to expect. They're just going to compare it all at the end. So I've got some clients that take this approach. If it's under X dollars, $20,000, I'm just going to write them one check and not have to remember those others. But if it's over that, I'll send them periodic. So if you send them one up front, no, you don't have to send the others. And the flip side is also true. If you don't send in the first 3 quarters, then you're fine, and you send a payment for the 4th quarter, you would just send in whatever you're paying, just have that recorded on that voucher.
so as far as the $15, write the check.
I would, I mean,
Now,
that's interesting.
the way I'm wired, I would want to fight it, so I get what the person's writing. Yes, I want to fight it, but yeah, just write the check and move on.
Yeah, I mean, it's, and some of this will depend a little bit on the tax preparer as well,
Okay.
as to whether or not they would charge for that time.
Oh, gotcha.
So if I can look at it and see fairly quickly and easily that, yeah, it's accurate, there was this issue, that issue, or, oh, there was a payment that, was supposed to be in on April 15th and it didn't get there till April 25th. Even if it was paid on time and the processing error is the IRS's, you're not going to want to pay my time to fight that.
Right.
Yeah. One of the other topics was itemizing versus standard deduction. So a lot of you may know and remember, at the end of 2015, they passed legislation, the Tax Cuts and Jobs Act, that did a lot of things. And one of the things that it did was it took the standard deduction and basically doubled it, but at the same time eliminated personal exemptions. So a married couple went from a standard deduction of around $12,000 to $24,000. Single went from like 6 to 12. So as we sit today, 2021, for a married couple, the standard deduction is $25,100. If both husband and wife are over 65, you increase to $27,800. So with those numbers, it becomes much more difficult to get over that threshold to where itemizing makes sense. To compound that challenge, in that same legislation, they put into effect a $10,000 cap on what we call SALT, the SALT limit. And SALT stands for state and local taxes. So when you add up your state income tax that you've paid in, whether that's through withholding or estimates or whatever it might be, or just the tax due on the previous year's return, as well as local taxes, plus, and this is the biggie for a lot of people, real estate taxes. Those all combine and you get capped at $10,000. So, people that live in the outskirts of New York City and Westchester County and that type of thing that are paying $16,000, $20,000 in real estate taxes alone, never mind their high state income taxes, and they just got cut off at $10,000. That made it very difficult for a lot of people to get to the itemization threshold. So once you get to that 10,000, well, now the other pieces to your itemized deductions can come from one of three places. Medical expenses, which outside of something catastrophic or living in a retirement community where a piece of your cost is a medical deduction, that's highly unlikely. Mortgage interest, which again, they put some caps in place, so it's limited to $750,000 of indebtedness now. And with rates where they have gone and everybody and their brother refinancing, those numbers have come down considerably as well. And then the last place is charitable contributions. So if you take each of those different buckets, one thing I forgot to mention, the medical expenses, you have to be over a threshold of 7.5% of your adjusted gross income. So again, you make $100,000 of AGI and you have $5,000 in out-of-pocket medical expenses, you're not getting a dime of medical deduction in your itemized deductions. So you take those pieces and combine them. And if you're under the 25.1 or the 27.8, if both people in the couple are over 27,000 or over 65, you have to be over the 27.8. It's just incredibly rare to have a married filing joint return where they're itemizing. They're either high income earners that are extremely charitable or in some type of medical facility where the costs are high. It is much more common to see a single person that's able to itemize because I think it's around 14,000 for 2021. The single standard deduction. Well, if you think about it, yes, as a single person, you don't have two incomes, so your state and local taxes are lower, but your real estate tax is no different. So that $10,000 limit, they didn't say, okay, it's $10,000 for a single person and $20,000 for a married couple. It's $10,000 per tax return. So you get to that 10,000. Well, now you only need to have another $5,000 or $6,000 of charitable contributions and mortgage interest where it becomes worthwhile to itemize. So it's a very low percentage of my clients, probably under 20%, I would say, that actually itemize. And it's either highly charitable, medical deductions that are driving it, or it's a single person, owns a house, pays real estate taxes, mortgage interest, that type of thing. The last topic that Wendy asked me to touch on a little bit is just small businesses. And that can mean a variety of different things from, just a side job that keeps people busy to it's, primary source of income, but it's still just a part of the personal tax return. There are a lot of people with small businesses out there. First thing I'd say is most, if not all, should be cash basis. They introduced as part of that 2017 legislation, they increased the thresholds where you are no longer able to use cash basis at a point of $25 million. And actually that's indexed out for inflation now, 25 million in revenue. So they're basically saying everybody should use cash basis. So if you have a small business and you're not, and it would be something to talk to your preparer about. A lot of people get hung up on depreciating property, and it's really not as much of an issue as you might think. There's the way the tax law is structured right now, pretty much anything you buy outside of maybe a vehicle, you can write off all at one time. The bigger question is, does it make sense to write it off all at one time? And so people get really excited about taking that deduction, getting that write-off. And that it's great that year, but it might not make sense in a big picture. So I've had this conversation fairly often, because somebody will buy, and let's just say it is a vehicle. The vehicles have special rules and there's some restrictions, but let's just say it's a vehicle and it's 100% business and it's a big SUV that meets certain weight qualifications and that type of thing. So you've got $50,000 of profit and you spent $50,000 on that SUV. You don't have any other income. Writing that SUV off all in 1 year does not make sense, because even if you're a single person, you've got a standard deduction. So you can get, basically you can let some income flow through, and that income just gets wasted if you bring your taxable income down to zero with just taking deductions. And there's some other pieces to it too, whether or not you think Social Security will be there long-term and that type of thing, but wiping out your self-employment income all in 1 year, or even driving it into a loss, even more of a waste in my mind. Preserving some of that deduction, keeping it going year to year, to me is a better long-term planning strategy. So it's one of the things that I try to help people do, is not just look at the current and what's the best thing for this year, but what's the best thing in a larger aggregate.
The other benefit of, you had touched on the QCDs, the qualified charitable donations. Any charitable minded, take it out of the IRA direct. Would you agree with that?
Absolutely.
Yeah.
And the biggest reason, Wendy and I've had this conversation. So if you have a $50,000 RMD and you say, okay, well, why can't I just take $50,000 out and then I'll take a $50,000 charitable contribution and I'm at the same place? And you're absolutely right. You're at the same place and you're going to pay the same amount of tax if you just took the QCD and sent it straight to the to the charity. The difference is the numbers in between, that AGI number, because there are certain things, one of them being your Medicare premiums, that are calculated off of the AGI number. And the QCD keeps that income out of that AGI completely and totally. And that can have a relatively large impact on what your premiums will be, and that there's a lag to that. So the 2021 income only impacts your Medicare premiums in 2023. So it's not something you'll see right away. There's a lag to it, but QCDs are so powerful. I'm so glad they made that permanent in the tax law, because it used to be that was something that we had to basically wait year to year, and they would have their extenders package, and it was always up in the air. So that was a great thing. And the other nice thing that they did was even though they raised the RMD age to 72, they didn't change the QCD qualifying age of 70 and a half. So that was another big benefit.
Yes. So, question, with tax season coming in here, and your life will change tremendously. Your wife will see you less. What would be your preference as one of the preparers that we work with? What's your preference on when you want to see people? Because the last thing you want is for them to come see you, and then they get their some form late because of an institution having to redo things because they got information late. So what would you say is the ideal time frame going into tax filing season?
So one of the pieces to that puzzle is working off of the prior year return. So if it's a matter of we're missing this information, then I want to make sure we don't file until we have that. So part of it is knowing that, because if it's a matter of I have everything except this one piece and I don't think I'm going to get that for another 3 weeks, well then for me personally, let's get together, let's get it worked on, and then we take that one piece and we drop it in and we finish things up. Especially as we get further out, I don't want to get that whole return at the beginning of April if there's just one piece that we could have had it, the second week of March. If it's something that you're prone to get corrections on, we should have that conversation then. Okay, here's everything, but I usually get a corrected from XYZ brokerage house. Again, let's work through it, and then let's wait and see if we get a correction. But at the end of the day, if you think you have everything ready and you don't expect any corrections, I would say get it done and get it filed. And then if you do end up with a correction, I'd say I see typically fewer corrections that they're not telling you ahead of time. So it's fairly common that they send one out, but they basically say, you'll probably have a correction in 20 days or something like that.
Okay. And I can answer, I'm going to hop over here again so you can see me. I can answer that the other tax professionals that we work with, that's pretty much a standard answer that they also would say, get the information to us, we'll get it in there. As you're working with us, we'll see that we're getting it to the proper tax preparer. But I don't see any other questions. So Steve, I just want to say thank you. Your expertise is amazing. You just sit there and, like you said, he could have went on and on, but we're going to cut it off just because of the time frame. And I would say to all of you that if you have questions specifically that you want to address more on a one-to-one nature, please let us know. Or we just really appreciate each one of you. And I thank you for taking this time. Steve, thank you. You have a lot to do getting prepared for your grand event, as we would say. And so we really appreciate you taking time to come out and share your thoughts. And again, to all of you out there in the Zoom world, thank you. We so appreciate you. And we continue to look for ways to make life easier and more pleasant. And for us that are shoveling snow, we're all ready for it. And for you in Florida, okay, we hear you laughing right now. But thank you. Thank you guys very much. We really appreciate you. Enjoy the rest of your day. Bye-bye.